The Federal Reserve says the coast is clear, last night announcing the largest banks in the U.S. passed their stress tests, meaning they are well equipped to withstand the dreaded R word, recession. The balance sheets of 34 of the largest banks did hold up when subjected to the Fed's economic storm model, meaning worst case scenario. Some passed with flying colors. Some, well, analysts say Bank of America, Citigroup, JP Morgan may have to raise their internal target ratios and hold back on stock buybacks. But all the names in the sector are charging higher right now. Goldman up 5.5%, Morgan's up 5%. You don't see Wells Fargo up there, but they are, at least the last I checked, they were having a bang-up day. Yes, they are the leader here, up 7.7%. You know, is it fair to think that these financials are going to right now have a big party and start giving out better dividends? And is that the right thing to do? Let's bring in Sheila Bair, the woman who ran the Federal Deposit Insurance Corporation from 2006 to 2011, of course, through the financial crisis, saving Americans' bank deposits as the world was losing trillions during the crisis. Welcome. It's great to have you. And when you see, yay, they all passed the stress test, and many are saying we are ready possibly next week, as early as next week, to give out better dividends and to announce share buybacks. Is that the right thing to do, or should they be holding back on some of the caution that they throw to the wind?
I think they should be very cautious. I mean, the stress tests are not as rigorous as they used to be, number one. The leverage ratio used to be a hurdle as well, which is a much tougher metric than the risk-based ratios that they use now. They don't have to show that they can expand their balance sheet to actually lend more during an economic downturn, because typically you will find in times of economic stress, non-bank intermediaries fail. Things collapse back into the regulated banking sector. That's certainly what happened during the great financial crisis. So those have all been eased. The length of time you have to sustain dividends has been shortened. So there's been a significant weakening of these stress tests to begin with. But I think most important is that they don't really stress the scenario that I am worried about and that a lot of people are worried about, which is that we go into a recession, inflation remains persistent, interest rates keep going higher.
Right.
That confluence, that perfect confluence of events, that is exactly what happened when Paul Volcker was chair of the Fed. Actually, he had to go through two recessions to get inflation under control, maintained interest rates at very high levels. That may well be what the Fed needs to happen, and that is the extreme stress scenario they should be preparing for. But that is not among the scenarios that banks had to show that they could survive and be resilient. So I think that is the more fundamental problem, really.
Whose brilliant idea was it to make these tests easier? They wanted.
Yeah.
It's like some of these fancy universities.
Yeah.
They want to pump up the averages, right? So they make it easier.
That's right. Well, this happened during the Trump administration, but there was some bipartisan support for it. So I'm not going to completely tag Republicans. As you know, I'm a Republican. But look, I just think the longer you get from the great financial crisis, memories dim. Is this really that important anymore? Do we have to be so rigorous here and there?
But we should. I'm sorry.
Well, I
remember what happened in 2008.
Yep. I do too. But a lot of people don't, or they have revisionist history in their mind about how bad it was or what the causes were. So, and then the bank lobbying is just relentless on this. And I really don't understand it. They're doing great. They've become globally dominant. They're very profitable. With the higher capital rules, why do they want to keep eroding and chipping away at something that actually has fulfilled their interest and the interest of their shareholders? So I do think they need to be cautious. We get into a deep recession and inflation remains high. That is very possible that could happen. I think their investors, their shareholders, want to make sure they've got very strong balance sheets and will be able to make some opportunistic investments as well if you get into a situation like that. So yeah, I hope they're cautioned. I don't think they will be, but I hope they will be.
Well, hope springs eternal. Speaking of debt, student loan debt, this has become a very important issue to you. We at our team, Claman Countdown, we started to look into this. We found a medical school graduate telling Business Insider that she has nearly $500,000 in student debt, worries she won't be able to pay rent to mounting costs. I mean, Joe Biden obviously has says he wants to erase $10,000 worth of debt for a group of people. There are certain metrics. You can't just be some wealthy lawyer who's making a ton of money and suddenly you get all of your debt erased. What do you think of this? And is this the right thing to do?
Debt cancellation, yeah, I have supported $10,000 of debt cancellation. I think if you look at who most benefits from that, it's really the lower income kids, the first generation kids, the kids that didn't go to good schools, for-profit schools, or weak schools. They didn't complete a degree, or they got a degree that wasn't worth anything. And so those are really proportionally the ones you're going to help. You're going to wipe out the debt of most of that cohort of students. Yes, where wealthier borrowers get a benefit from the 10,000. Well, yes, you could means test it, but the problem is with means testing, the complexity, administrative complexity that involves to make these kids come in and document income will mean that a lot of them don't get the help. There are programs right now to help them, but because of the bureaucracy surrounding applying for and documenting income, they and their families just don't understand how to do it. So I do think $10,000 of debt cancellation, that's a personal view, not one that with organizations I'm otherwise affiliated with. But I do think that's justified. But it would be irresponsible to do that without more fundamental reform to the system to make sure we just don't get right back into the soup again, even providing this relief.
Sheila, always a pleasure to have your very clear-eyed assessment of this, and we do appreciate you coming on.
Yes. Okay. Thanks so much, Liz.
Sheila Bair.
Bye-bye.